What if the Fed's next decision changes the way you should invest your money? Because here's what most investors get wrong. They focus on whether the Fed will cut, hold, or raise rates. But the bigger question is, what does that decision mean for your stocks, bonds, cash, and overall portfolio? And there's one scenario that could surprise investors. So let's break it down. Every time the Federal Reserve makes a major policy decision, Wall Street starts asking the same question. What's next? Will interest rates come down? Will rates stay higher for longer, or could inflation change the Fed's plans? And most importantly, what should investors do? The problem is that financial headlines often make this sound much simpler than it really is. You hear, rate cuts are bullish, or higher rates are bad for stocks. But investing isn't that simple. The market doesn't just react to what the Federal Reserve does. It reacts to what investors expected the Federal Reserve to do, and understanding that difference could completely change how you look at the next Fed decision. Let's start with the basics. The Federal Reserve is the central bank of the United States. One of its most important tools is the federal funds rate, which influences borrowing conditions throughout the economy. When interest rates are higher, borrowing generally becomes more expensive. That can affect consumers, businesses, mortgages, credit, corporate financing, and the returns investors can get from relatively safer assets. And when rates move lower, financial conditions can change in the opposite direction. But here's the important part. The Fed doesn't directly tell you whether to buy Apple, Nvidia, an S&P 500 index fund, treasury bonds, gold, or Bitcoin. Instead, its policy changes the financial environment in which all of these assets operate. That's why investors pay attention, and that's why the next decision matters. But there's something even more important happening beneath the surface. Imagine investors expect the Fed to cut rates, and for weeks, traders position themselves for that possibility. Stocks move, bond yields adjust, the dollar moves, and investors prepare. Then, the Fed actually cuts rates. You might think stocks should go up, right? Not necessarily. And this is where one of the most important concepts in investing comes in: expectations. If the market already expected the rate cut, then the cut itself may not be a surprise. But what if the Fed cuts rates and signals that future cuts may be slower than investors expected? Suddenly, the headline sounds bullish, but the market reaction could be very different. That's why you should never look at a Fed decision in isolation. You need to understand the message behind the decision. So let's look at the three broad possibilities investors should be prepared for. Rates could move lower, rates could stay where they are, or rates could stay higher for longer, or policy could become tighter than investors expected. And here's the key. None of these scenarios automatically tells you what the stock market will do. Why? Because the reason behind the Fed's decision matters. Suppose the Federal Reserve becomes more comfortable with inflation and decides that financial conditions can become less restrictive. A lower policy rate can eventually reduce borrowing costs. That can support businesses and consumers. Some companies may benefit from cheaper financing, and investors may become more willing to put money into riskier assets. This is one reason rate cuts are often associated with a more favorable environment for stocks. But there's a major catch. Why is the Fed cutting? If inflation is cooling and the economy remains relatively healthy, that's one situation. But imagine the Fed is cutting because economic growth is deteriorating rapidly. That's completely different. Same rate cut, different economic message. And this is the part many headlines leave out. A rate cut isn't automatically a green light to buy everything. You need to understand why the Fed is changing policy. Now, let's say the Fed keeps rates where they are. Some investors may see that as disappointing. But a pause doesn't necessarily mean something is wrong. It could simply mean policymakers want more information. Inflation, employment, economic growth, and financial conditions are all pieces of the puzzle. And for investors, a period of steady rates can actually create an interesting environment. Cash and short-term fixed-income investments may remain relatively attractive. At the same time, companies with strong balance sheets and reliable cash flows may become even more important. And this brings us to a question you should ask yourself. If interest rates stay higher for longer, what kind of companies would you rather own? When rates are high, investors have to think differently about valuation. Imagine you have two companies. Company A is profitable today and generates strong cash flow. Company B expects most of its growth many years from now. When interest rates are low, investors may be willing to pay a high price for those future earnings. But when rates are higher, those future cash flows can become less attractive when valued in today's dollars. That's one reason some growth stocks can be particularly sensitive to interest rate expectations. But this doesn't mean high rates equal sell growth stocks. That's far too simplistic. A great company can remain a great company. The real question is, what price are you paying for that growth? That's where valuation comes into the conversation. Now let's consider the third scenario. The Fed keeps rates higher for longer than investors expect. This could happen if inflation proves more persistent than policymakers want. And this scenario matters because investors may have to adjust their expectations. If markets were expecting rapid rate cuts and those cuts don't happen, some assets could reprice. Bond yields could move, equity valuations could change, and borrowing costs could remain elevated, and investors might become more selective. But here's another important point. Markets don't wait for the Fed to make the announcement. Investors constantly try to anticipate what comes next. That's why the market can move before the actual Fed meeting, and that's why trying to trade every headline can become extremely difficult. So now we get to the question you probably came for. What should investors actually do? My answer is, don't build your entire investment strategy around predicting one Fed meeting. Instead, start with your own financial situation. If you're investing for retirement 20 years from now, your strategy probably shouldn't depend on what happens at the next FOMC meeting. But if you're going to need your money next year, that's a completely different situation. Your time horizon matters, your risk tolerance matters, your emergency savings matter, and your asset allocation matters. The Fed can change policy, but you still have to live with the portfolio you built. So let's quickly break down the major categories. For stocks, focus on quality, diversification, earnings, cash flow, and valuation, not just the next Fed headline. For bonds, understand that interest rate expectations can have a major effect on bond prices and yields. If you're using bonds in your portfolio, understand your maturity and interest rate exposure. Cash isn't necessarily doing nothing. It can provide liquidity and stability, especially when short-term yields are attractive. But remember that inflation can reduce purchasing power over time. And that's why the right answer usually isn't stocks or bonds or cash. For many investors, it's about finding the right balance. And what about gold and Bitcoin? These assets get a lot of attention whenever markets become uncertain. Gold is often viewed as a diversification asset and a potential store of value. Bitcoin is much more volatile and has a very different risk profile. So don't make the mistake of thinking, the Fed cuts rates, therefore Bitcoin goes up. Real markets don't work that cleanly. There are multiple forces affecting prices at the same time. And that's why you should think in terms of probabilities, not certainty. Before you make any major investment decision because of the Fed, ask yourself 3 questions. Number 1, what's my investment time horizon? 5 years, 10 years, 20 years, or do I need this money soon? Number 2, how much volatility can I actually tolerate? Not how much volatility you think you can tolerate, but how much you can handle when your portfolio is actually falling. Number 3, am I investing or am I trying to predict the future? Because those are 2 completely different things. You don't need to know exactly what the Fed will do to become a successful long-term investor. You need a strategy that can survive when your prediction is wrong. And that's the biggest lesson here. The Fed's next decision matters, but it shouldn't control your entire financial life. The Federal Reserve will make another decision after this one, then another, and then another. Markets will rise and markets will fall. Inflation will change, interest rates will change, and economic growth will change, but your long-term investment plan can remain surprisingly simple. Diversify. Understand what you own. Don't overpay for assets. keep an appropriate cash reserve, and avoid making emotional decisions based on a single headline. The goal isn't to predict every move. The goal is to be prepared for different outcomes. So before the Fed makes its next decision, don't just ask, will rates go up or down? Ask a better question. Is my portfolio prepared for either outcome? Because that's what separates an investor from someone simply reacting to financial news. And if you want more straightforward breakdowns of the Federal Reserve, interest rates, stocks, ETFs, and the U.S. economy, make sure you subscribe to Rahatinvests. And tell me in the comments, do you think the Fed's next decision will be more important for stocks, bonds, or cash? I'll see you in the next one. And if you want more straightforward breakdowns of the Federal Reserve, interest rates, stocks, ETFs, and the U.S. economy, make sure you subscribe to Rahatinvests. Then continue. And tell me in the comments, do you think the Fed's next decision will be more important for stocks, bonds, or cash?